Hey, this is Sasha. Welcome to another episode of Hungry for Returns, where I answer your trading and investing questions on video because sometimes the written word is not enough and video is much more detailed. So today we have another question regarding iron condor. So take a listen here and we'll go to the question.
Hi, Sasha. This is Jim. My question for today is regarding how to manage iron condors while I'm working a 9-to-5 job. This is what I've been doing, and I would like to know if I'm making any mistakes. I will be using $200 and $150 as the wings of this iron condor. What I do is I calculate 5% below the call price. In this example, $200 times 5% is $10. So I set alerts $10 away from each side, which would be $190 on the call side and $160 on the put side. I would then make any adjustments if these alerts were reached. Is this a good strategy? Also, when I set up these alerts, I also write a good to cancel sell order to capture 50% of the original premium received. If I receive $250, my position would be closed out at $125. Is this a good strategy for me? As always, thank you for your advice.
Okay, so this one's a little more difficult of a question to even answer, just to think about the numbers here. So looking at the overall question, here I have an iron condor setup. Basically what Jim was saying was that he's looking at a $200 strike, and then he goes 5% below that, which is $10, putting it at $190. I think the better approach for me to answer this question is to really look at where to set the alerts, right? So you're looking at where to set the alerts, how to set those alerts, and if that's a good approach to making adjustments. The problem with putting an alert in with options you have to take into account is the software is not really set up to handle option alerts as well as it could. Most software is not. So the issue there is it doesn't take into account the volatility issue. So for example, if a stock is moving, especially with iron condors, you are a negative vega, right? So with a negative vega, you have a volatility problem as a stock heads lower, okay? So what you would probably want to do is, let's just say normally you set a 5% alert on the downside. Well, you might want to set a 3% alert on the downside because you want that alert sooner, okay? Because you have volatility that's in play. To the upside, you might want to set that alert even beyond 5%. You could say 6% or 7%. If you want to use 5%, that's fine too. That's because the volatility will actually help you a bit, okay? And this is how this really works, is take a look. If I pop out the volatility here, and let's just say I pop up 5% volatility going higher, which means stock price is going lower, you can see I'm down $592 on this position, which is on Apple about a $200 stock here. Now, if I have a negative 5%, you can see if volatility contracts, you know, I'm up $400. Now, granted, the price would be at higher levels, but I'm up way up there because volatility has contracted. So you can see that you need an alert that takes volatility into account, which means on iron condors with negative vega, you want that alert a little bit sooner on the downside, and you could make it a little later as the stock is climbing up. Now, going back to the alert system and when to look at setting an alert or a mental trigger, the mental trigger that I look at typically is not necessarily a pricing trigger. Instead, what I would prefer to look at is probabilities, and that's how most option traders look at, excuse me, when they look at putting on or selling contracts, is they look at not this open interest, but this column is the probability of in the money, okay? So when you look at probability of in the money at this 190 right here, what happens is at 190, that's a 9% probability that if you buy this option, you're going to have a 9% chance it'll work out for you in the money. Okay, which means if you're a seller, you basically have about a 90% chance of success. Now, here you could switch this to probability of out of the money if you like seeing this. And as you can see right here, well, the closer you are to the strike price at 210, let's say, well, 65% chance of success, right, if you're a seller. Okay, whereas all the way down here, if you're buying a put, well, chances are a $90 put's going to expire worthless. So you kind of only have a, less than 0.3% chance of success if you're a buyer. But if you're a seller, you got a 99.78% chance of success. But the premium is you only make 3 cents, right? Because, well, you have a 99.78% chance of success. So anyways, normally when we look at triggers and alerts, probabilities is what we use, in the option world. So looking at it that way with iron condors, because they're a probability kind of spread. But as far as pricing, if you want to do pricing and that's easier, you could do it that way. Just understand that for the downside move, you have to take vega or volatility into account, because it's going to create a larger loss. It's going to create a loss for you quicker than it will on the upside. I hope that makes a little bit more sense. All right, thanks for joining me. If you want to ask your own question, then submit one on tradersfly.com or click this link right here or join the newsletter. Check out our website at tradersfly.com, and then you can submit your own question there by voice or even send us in a video. But if you want to just subscribe on YouTube, hit the button right below this video and you'll get notified as I release new videos. Thanks again, and I'll see you next time.